Welcome to the Deep Dive. Today, we are strapping in for a thorough exploration of, well, the conceptual foundations of financial strategy. We're focusing on the very bedrock of the ACCA financial management paper. That's Chapter 1, Financial Management Objectives.
Right.
Now, I know what a lot of you are probably thinking. Oh, this is the easy chapter, the definitions chapter before the real fun, the investment appraisal, and all the calculations begins.
And that mindset, if I can just jump in, that is unfortunately exactly what prevents students from hitting those really high marks in the constructed response questions.
Okay.
This introductory material is far from easy. I'd say it's the most critical conceptual foundation you'll study.
Why is that?
Because it defines the why that underpins all of the how. I mean, you can calculate a net present value perfectly, but if you can't discuss why that result matters, how it aligns with the company's main objective of maximizing shareholder wealth, and what constraints, like, say, market efficiency, limit your ability to achieve that goal, you are just leaving half the available marks on the table.
Okay, so let's really unpack this then. Our mission today is explicitly tailored for you, the future financial manager listening to this. We want to go beyond just, rote memorization of the FM's 4 core functions. We want to establish a powerful conceptual flow. So, objectives drive strategic decisions.
Yes.
Those decisions are then influenced by the turbulent environment of the financial markets, and risk is the central trade-off governing every single action.
That's the chain.
If you can grasp the logic and the connections we're about to make, you'll be equipped to frame those sophisticated, high-scoring discussion answers in your Section C of the exam.
And that's the goal. The core role of the financial manager, it sounds deceptively simple, but it's vast in its implications. It's about making the right decisions now, about raising funds, about investing those funds to achieve the organization's objectives in the future.
That future focus is key.
It's paramount. And for a commercial entity, the primary objective is maximizing shareholder wealth. That means making decisions that increase the value of the owner's stake, which is generally reflected in the company's share price over the long term.
So if the ultimate long-term goal is maximizing shareholder wealth, the FM's activities really need to be strategic. The job description covers 4 areas, but 2 of them really stand out as the strategic long-term pillars, the ones that define the company's destiny.
Indeed. These are the 2 decision areas that demand the most sophisticated analysis and involve the greatest capital expenditure: the investment decision and the long-term financing decision.
And they're linked, I assume.
They're intrinsically linked. You can't separate them. The decision to invest has to be supported by the funds you raise, and the cost of those funds defines whether the investment is even viable in the first place.
Okay, so let's start with Pillar 1 then, the raising of long-term finance. This is the big strategic capital structure decision. Where does the money come from, and what does that choice mean for the company's risk profile?
A company constantly needs capital. It's for funding major growth initiatives, product development, or just replacing assets.
The basics.
The financial manager's challenge is to navigate all the different sources available and select the optimal mix, focusing always on the future cost and the future risk. This is where we sort of leave the realm of trade credit and short-term bank loans.
Right.
And we step into the specialized domain of the capital markets. We're talking about funds typically required for periods of 5 years or more.
And when we look at those capital markets, we're broadly categorizing capital into 2 fundamental types, right? We're talking equity and loan capital.
That's correct. Equity represents ownership. It's primarily through ordinary shares, and sometimes you see preference shares. This money comes from investors who accept the highest risk in exchange for, they hope, the highest potential return.
Capital growth and dividends.
Exactly. Then you have loan capital or debt. This comes in the form of debentures or bonds. These investors receive a fixed interest rate and generally have a lower risk profile because they're prioritized if the company goes into liquidation.
And the market complexity reflects the companies being financed. I mean, we're not just talking about the main stock exchange here, are we?
Absolutely not. The main market, sometimes you'll hear it called the official list. That's for the largest, most regulated, and most established companies. But for smaller or growth-oriented companies that, can't meet those stringent requirements,
Or just don't want the hassle.
or just want less regulation and lower cost, there's the alternative investment market, or AIM. And that offers a vital route for growth capital.
And at the very top end.
For the largest, the truly global corporations dealing with finance terms, often stretching 10 or 15 years, they look toward international solutions like the Eurobond market. That's where bonds are denominated in a currency that's different from the issuer's home currency, which often appeals to specific international investor pools.
Now, before we pivot back to that strategic choice between debt and equity, we have to touch on the role of financial intermediaries, the banks, investment funds, and so on, because they facilitate this massive flow of capital from savers to borrowers. The sources stress 3 key functions they perform. Let's expand on those, because they provide great context for any discussion answer.
Yeah, these functions explain why intermediaries are so essential. First, they provide aggregation.
Aggregation.
Think about it. A company might need a loan of, say, $100 million. No single individual has that sitting in a current account. The intermediary, like a bank, aggregates millions of small deposits from countless individuals. $500 here, $2,000 there, and consolidates them into that massive corporate loan. Without that, large-scale projects would just be impossible.
That makes perfect sense. The second one, maturity transformation, that's a bit more abstract, but I know it's vital.
It's the magic trick of banking, really. An individual saver might only want to keep their money liquid for, say, 3 months. They need short-term funds. But the company needs that $100 million loan for 10 years. A long-term maturity.
A huge mismatch.
A huge mismatch. The bank transforms these short-term liabilities, the deposits, into long-term assets, the loans. And it operates on the trust that not everyone will withdraw their money at the same time. They manage that maturity mismatch, which is a major source of financial risk, but it's essential for economic activity.
And the third function, diversification of risk, that directly addresses the central theme of this entire paper.
Precisely. As an individual, you might be, terrified of lending your life savings directly to one startup company, because if it goes bankrupt, your loss is 100%.
Of course.
But when you deposit that money in a bank, the bank lends that cash to thousands of companies across every sector. Your exposure to the bankruptcy of any single one of those companies is minuscule. The intermediary facilitates the diversification of risk across a broad portfolio, and that significantly reduces the exposure for the individual whose funds are ultimately being deployed.
That contextualizes the market perfectly. Okay, so back to the FM's main choice. Equity versus debt. Debt increases financial risk or gearing for the company, but there is a massive conceptual benefit that financial theory, particularly the later work of Modigliani and Miller, highlighted so clearly regarding corporate tax.
Yes, the benefit is the tax shield on debt. Interest paid on loan capital is generally treated as a tax-allowable expense. This means the actual cost of debt to the company, net of tax, is lower than the gross interest rate. If your corporation tax rate is, say, 30%, a 10% interest payment only really costs the company 7% after you account for the tax saving.
And that's completely different from dividends.
Completely different. Contrast that with dividends, whether for ordinary or preference shares, which are paid out of after-tax profits.
So the tax deductibility of interest creates this inherent subsidy for debt financing, which makes it mathematically cheaper than equity, regardless of the explicit risk profile. That's a huge driver in capital structure decisions, and it's something the examiner will expect you to discuss when you're tackling cost of capital later on.
It is the ultimate linkage. This tax advantage encourages higher gearing, but the FM has to balance this cost saving against the increased risk of bankruptcy, because fixed interest payments have to be made regardless of profitability, unlike dividends, which, can be skipped in a bad year.
All right, moving to Pillar 2, the investment decision. This is where the company commits its resources for the long term. We're talking about major capital expenditure, buying a new machine, launching a new product line, building a new factory wing, or even merging with or acquiring another firm.
The investment decision is the engine of shareholder wealth maximization. It's simple, really. If you invest in projects that generate returns greater than the cost of the capital used to fund them, you are creating value.
So the FM's job here is twofold.
Exactly. First, identifying viable projects, and second, defining the criteria used to make the final acceptance decision.
And this is where we bring in the time value of money, right?
Absolutely. The foundational objective maximizing long-term shareholder wealth demands that we use discounted cash flow techniques, primarily net present value, NPV, and secondarily internal rate of return, IRR.
And why is that so important?
Why? Because maximizing wealth requires recognizing that $1 today is worth more than $1 tomorrow. NPV correctly discounts all those future cash flows back to a present value using the cost of capital, ensuring we only accept projects that genuinely add value.
So simpler methods don't cut it.
Using simpler non-discounting methods like, say, accounting rate of return, or the payback period, while they might be useful for a quick risk management check or a liquidity check, they violate the core objective because they just ignore the timing of cash flows.
That's a crucial distinction. We're interested in the cash flows, not the accounting flows.
Indeed. When you're calculating cash flows for investment appraisal, the FM must strictly adhere to the rule of relevance. We are only interested in future incremental cash flows.
Okay, so what does that mean we ignore?
It means ignoring sunk costs, money that's already been spent, it's gone, ignoring historical costs, ignoring non-cash items like depreciation, which is just an accounting allocation, not a real flow of cash, and crucially, ignoring interest costs and dividend payments.
Why ignore those? That seems counterintuitive.
Because the cost of that finance is already handled separately and comprehensively through the discounting process. That's what the cost of capital is for. Getting the input cash flows right is absolutely essential before you even think about applying the NPV model.
So we have the strategic pillars, raising finance and investing it. But as we established, these decisions aren't made in a vacuum.
Not at all.
They're constrained by the external environment. And this is where high-scoring students really differentiate themselves by showing an awareness of these real-world operational challenges. The central environment we have to discuss is the financial market itself, particularly the stock exchange.
That's right. The stock exchange is a crucial entity because it links the providers of capital, the investors, with the users of capital, the companies. It has a dual function that you need to understand conceptually.
Okay.
First, it ensures an orderly, fair, and efficient market for the transfer of existing securities. This gives investors liquidity. Second, it's a mechanism for companies to raise new capital through primary issues.
And to achieve that sense of fairness, the regulation has to be incredibly stringent.
It has to be. These regulations are designed to achieve three things. Suitability, so ensuring only legitimate, stable companies are traded. Transparency, mandating public availability of all relevant information so investors can make informed decisions. And equality, ensuring all investors deal on the same terms and at the same prices. This regulation is the primary mechanism for protecting the public and encouraging trust in the market, which is vital for capital formation.
But even with all those rules, share valuation isn't just a simple calculation. It's a dynamic process driven by market psychology, that point where a willing seller meets a willing buyer. And this is constantly influenced by speculation. Here's where it gets really interesting for me.
The bulls and the bears. This dynamic interplay is what ensures the market stays liquid. A bull is optimistic, they're buying stock in anticipation of a price rise. A bear is pessimistic, selling now because they expect the price to fall, hoping to buy it back later at a lower price.
It sounds a bit like gambling.
It does, but this speculative activity actually serves two critically important market functions.
How does speculation improve market function? I would intuitively think it just adds a lot of volatility.
And that's the common misconception. Speculation, through a process called arbitrage, actually reduces market fluctuations.
Really? How?
Well, if a stock price starts to fall too low relative to its inherent value, bulls, the speculators hoping for a rise, they step in to buy up the discounted stock. This increased demand stops the price decline.
And the other way around.
Conversely, if a stock price shoots up too quickly, bears sell aggressively, recognizing the temporary overvaluation, and that caps the price. They are constantly forcing the price back toward its underlying equilibrium based on the available information.
Okay, so that's one function. What's the other?
Secondly, speculation ensures a ready market in all shares. Regardless of market sentiment, there's almost always a bull willing to buy and a bear willing to sell at some price, and that guarantees liquidity for investors who need to get in or out.
That ties directly into the concept that defines the theoretical limits of financial management: market efficiency. We have to discuss the efficient market hypothesis, or EMH. What does efficiency actually mean for the FM?
The EMH is the idea that an efficient market ensures quoted share prices accurately and quickly reflect all available information about a company's current and future profitability. If a market is efficient, the share price truly represents the maximized value of the firm, which directly reflects the achievement of the FM's primary objective.
And we break this down into three progressively stricter forms. Let's make sure we clearly differentiate them for everyone listening.
The first is weak form efficiency. This posits that current share prices reflect only historical price and volume data.
So what's the implication of that?
The implication for the FM and for investors is that technical analysis, trying to predict future prices based on charts of past trends, is useless. If the market is only weak form efficient, prices follow what we call a random walk, changing only when genuinely new information hits the market. That renders historical data irrelevant for forecasting.
Okay, then we step it up to semi-strong form efficiency. This is where the concept becomes highly practical.
It does. In a semi-strong market, prices reflect all publicly available information. This includes annual reports, quarterly results, press releases, news articles, economic forecasts, everything.
So the only way to get an edge is?
If the market is semi-strong efficient, the only way to consistently earn abnormal returns is by knowing information that has not yet been released to the public, which leads us straight to the crime of insider dealing.
Which is illegal, highlighting a key regulatory constraint.
Exactly. The very existence of strict insider trading laws suggests that gains can still be made using private information. And because of that, we generally conclude that the real-world stock market is, at best, operating at a level of semi-strong efficiency. It's not perfect.
And finally, the theoretical ideal strong form efficiency.
In a strong form market, prices would reflect all information, both published and unpublished. In this theoretical scenario, even insider dealing would be impossible because the market price would have already fully incorporated the private information held by managers or directors. Since we know insider dealing is possible and illegal, we know that strong form efficiency does not exist in reality.
This non-fully efficient reality, this market that is only semi-strong at best, that has profound practical consequences for the financial manager who's trying to maximize shareholder wealth. This is the link the examiner absolutely loves to see you make.
Let's detail those four major implications. First, consider the timing of new issues. If the market isn't perfectly efficient, share prices can temporarily deviate from their true fundamental value. An astute financial manager can take advantage of this temporary mispricing by timing the issuance of new equity.
How so?
If the company is about to release some really positive news, the FM might launch the equity issue just before that news hits the public, capturing a higher price for the shares being issued and maximizing the funds raised.
Okay, got it. Second, project evaluation is compromised. This is a direct link back to Pillar 2, the investment decision.
It is. If the share price isn't perfectly fair because the market is inefficient, then the true required rate of return demanded by the market, the cost of capital you use as the discount rate in your NPV calculations, is inherently difficult to know accurately.
Because the starting point is flawed.
Your whole calculation is flawed from the outset. We base our cost of equity calculation on the current market share price, but if that price is volatile or mispriced, it undermines the rigorous application of the wealth maximization objective.
Third, and this one is perhaps a bit more cynical, the implication for creative accounting.
Yes. Unless the market is fully strong form efficient creative accounting. So, manipulating figures within legal bounds can still be used, at least temporarily, to mislead investors. By making performance look better than it really is, the share price can be temporarily inflated. This appears to support the objective of maximizing shareholder wealth, even if the underlying economics are unsound. In a truly efficient market, such manipulations would be instantly discounted by rational investors.
But in our reality, they can persist for a while.
They can. And finally, the implications for mergers and takeovers in M&A.
Right.
In a theoretically fully efficient market, every company is valued fairly. Therefore, if Company A buys Company B, Company A should only agree to pay a premium over Company B's current fair market price if that premium can be justified by achieving significant measurable economies of scale or rationalization that make the combined entity worth more than the sum of its parts.
But if the market isn't efficient?
If the market is inefficient, however, companies might engage in M&A simply because they believe the target company is currently undervalued, a speculative maneuver rather than a true value-adding synergy play. The FM has to scrutinize any M&A decision through that lens of efficiency and genuine value creation.
Let's pull the discussion right into the 21st century now by acknowledging fintech financial technology. For the FM student, this is a conceptual area that shows you're aware of modern pressures. It doesn't require complex calculations, but it does require a deep understanding of its disruptive nature.
Absolutely. Fintech is the application of technology to fundamentally improve and, well, disrupt traditional financial activities. This spans everything from the rise of app-based banking and peer-to-peer lending to incredibly cheap, instant international currency transfers and platforms for trading complex instruments or cryptocurrencies digitally.
The benefits are pretty tangible, and they directly impact the economy. You get instant access to services, dramatically lower fees because there's less physical infrastructure, and just greater convenience for the customer. It forces the traditional financial institutions to become leaner and more competitive.
It does. However, the FM must focus on the inherent risks that fintech introduces. The most immediate danger is the security threat.
Cybercrime.
Exactly. As more financial activity moves online, the risk of sophisticated hacking, data breaches, and cybercrime increases exponentially. This requires continuous and significant investment in cybersecurity measures. It's a non-negotiable cost now.
And the second major danger relates to the stability of the entire system.
That's the issue of government regulation and oversight. Traditional finance is heavily regulated to protect consumers and maintain financial stability. But regulators are constantly playing catch-up with these rapidly evolving fintech platforms, particularly regarding anti-money laundering or AML protocols. Fintech's speed and anonymity can, if it's not carefully controlled, be exploited to convert illegally earned money into legitimate funds. And that poses a major systemic risk that FMs have to be highly attuned to.
Okay. Now let's pivot to the central concept governing all financial decisions, whether it's old school or fintech-driven, the risk-return trade-off. The cost of capital, which we use to appraise investments, is directly determined by interest rates, and those rates are dictated by a whole constellation of factors.
We can break down the determinants of interest rates into, well, 5 main categories. First, the obvious one, the general level of rates set by the central bank, like the base rate. Second, and this is the most crucial one for the FM, is the level of risk. Higher risk always demands a greater expected return.
Okay, can we expand on that risk element? For the listener, what is the clear difference between the risk a shareholder takes and the risk a bank depositor takes?
Oh, it's massive. A building society depositor accepts minimal risk. Their capital is usually guaranteed up to a certain level, and they receive a small fixed return. A shareholder, investing equity, accepts maximum risk. They are last in line if the company fails, and therefore they demand a substantially higher expected return. That's why the cost of equity is almost always significantly higher than the cost of debt. This subjective relationship, the trade-off, varies by individual attitude toward risk, but the principle is universal. No reward without risk.
And to make the FM's understanding of risk truly complete, we have to differentiate between the two fundamental types of risk that feed into this trade-off. We mentioned them briefly in the summary, but they are absolutely essential for understanding portfolio theory and the cost of capital.
This is a critical point that links to more advanced ACCA concepts like the capital asset pricing model, or CAPM. We must distinguish between unsystematic risk and systematic risk.
Okay, let's start with unsystematic risk. What's that?
Unsystematic risk, sometimes called specific or diversifiable risk, is unique to a particular company or a particular industry. Examples would be a localized labor strike, the death of a key executive, or a company-specific product failure.
So things you can't predict.
Right. But if an investor holds a large, well-diversified portfolio of shares across many sectors, this specific risk can be virtually eliminated, because bad news for one company will likely be offset by good news for another.
Okay, so you can diversify it away. What about systematic risk?
Systematic risk, or market risk, is the risk that's inherent to the entire market or the entire economy. So we're talking about recessions, interest rate hikes, inflation, geopolitical instability. No matter how well diversified your portfolio is, you cannot eliminate systematic risk because it affects every company.
And that's the key takeaway for the FM.
This is the crucial takeaway. Investors do not receive compensation, so a higher expected return, for bearing unsystematic risk because they could have simply diversified it away. They only receive a higher return premium for taking on systematic risk.
That is the link. So the cost of capital calculation later in the syllabus, it uses the beta factor, which measures a company's exposure only to systematic risk. That conceptual separation starts right here in Chapter 1 with this risk-return trade-off.
Exactly. Now for the remaining, more logistical determinants of interest rates. Third is the duration of the loan. Generally, a longer term means higher uncertainty, so assuming stable underlying rates, a longer loan commands a higher interest rate premium to compensate the lender for tying up their cash for a longer time.
Makes sense.
Fourth, the need for financial intermediaries to make a profit. They have to charge the borrower more than they pay the depositor. And fifth, loan size. Very large sums often benefit from economies of scale in administration, which can sometimes translate into slightly lower effective rates.
These determinants all culminate in shaping the yield curve, which shows how the yield or the return of a security changes based on its time to maturity, the term structure of interest rates. Why is the shape of this curve essential knowledge for the FM?
Because the yield curve is a potent indicator of the market's expectation of future interest rate movements. The FM has to interpret this curve to make strategic finance choices. For example, should we lock in a long-term fixed rate now, or should we use cheaper short-term floating debt, hoping that rates will fall?
Okay, let's delve deeper into the three theories that try to explain the shape of this curve. I think this level of conceptual detail is what secures those top marks in the exam. So, theory one, the expectations theory.
This is the simplest theory. It argues that the shape of the curve merely reflects the market's collective expectations about future interest rates. If the yield curve is upward sloping, so longer-term yields are higher than short-term yields, it means the market expects rates to rise in the future.
And if it's the other way around?
If the curve is inverted, so short-term rates are higher, the market expects a rate decline, which often signals an impending recession. And if it's flat, stability is expected.
Okay. Theory two, liquidity preference theory. This directly builds on that risk-return trade-off we just discussed.
It does. This theory argues that investors fundamentally prefer liquidity. They prefer having their cash readily available. Therefore, to persuade them to tie up their funds for a longer duration, they have to be compensated with a higher yield premium.
So it's always going to be upward sloping, according to this theory.
This theory inherently predicts an upward sloping yield curve, even if interest rates are expected to remain stable, just because investors demand compensation for the deferred use of their cash. The longer the term, the higher the liquidity premium they demand.
Right. And finally, the segmentation theory. This suggests the market isn't just one smooth entity.
That's it. Segmentation theory posits that different segments of the market operate independently due to investor preferences. For example, commercial banks might focus primarily on short-term lending, while pension funds might only invest in long-term bonds.
So they're not even competing.
They're not. This means the supply and demand for funds in the short-term market is unrelated to the supply and demand in the long-term market. The curve shape in a particular segment just reflects the prevailing attitudes and dynamics of the specific investors active there. You sometimes even get discontinuities jumps, where the short-term segment meets the intermediate segment. The FM has to analyze which segment they are operating in to understand their true cost of debt. We've established the objectives, the two core decisions, the constraints imposed by market efficiency, and the inescapable presence of risk. Now, let's bring this all back full circle into the exam hall. If I'm sitting Section C, why is this foundational chapter not just useful, but absolutely essential for achieving that synthesis?
Because the objectives dictate the criteria for investment appraisal. That was Pillar 2 and the funding source and mixed Pillar 1. If you're asked to comment on an investment decision, the calculation is just the starting point.
You must link the calculated NPV back to the constraints we've just discussed. Does the project accept systematic risk that the company should be taking on? Does the project alter the capital structure, thereby changing the true cost of capital? This demonstration of connection is what moves you from a pass into the high-scoring band.
Okay, let's address the most common mistakes you see students making that prevent them from achieving this synthesis.
The first major mistake is mistake 1, treating financial and investment decisions in isolation. Students will calculate an NPV, but they fail to critically assess the discount rate they are given, the cost of capital. Remember, the cost of capital, often expressed as the WACC, is directly dependent on how the finance is raised, the capital structure or gearing.
Wait, can you elaborate on that WACC limitation? This is where foundational concepts meet advanced strategy.
Absolutely. The weighted average cost of capital, the WACC, can only be used as the discount rate for a new project if two conditions hold. 1, the project is financed using the same mix of debt and equity, the same capital structure, as the existing company. And 2, the project has the same systematic business risk as the existing company.
So if the risk profile changes, you can't use the old WACC.
You cannot. If, for instance, a historically safe utility company decides to launch a highly speculative venture into, say, cryptocurrency mining venture with a completely different risk profile, a much higher beta light, the FM cannot use the existing low WACC. Doing so would incorrectly lead them to accept a risky project that actually requires a much higher expected return to be worthwhile.
That immediately proves that Chapter 1's discussion of risk and finance structure is inseparable from later calculations. What's the second common mistake?
Mistake 2, missing the contextual constraints. When dealing with valuation models, students often just apply the formula without acknowledging its flaws, which is a key requirement of critical analysis. Take the dividend valuation model, the DVM, that we use to estimate the cost of equity. When you're asked to comment on the result, you must discuss its practical limitations.
What are those practical hurdles the FM faces when applying the DVM in the real world?
Well, there are three main problems. First, the assumption of non-perfect efficiency. As we noted in Section 2, the share price you're plugging into the formula might not be the fair price, and that skews the result.
Okay.
Second, the DVM assumes dividends grow at a constant rate, G, in perpetuity, which is highly unlikely in reality. Companies go through cycles. And third, and this is perhaps the biggest hurdle for the FM, is the difficulty of estimating the expected growth rate, G.
Where do you even get that number?
Exactly. Is the market looking at historical growth, analyst forecasts, the management's optimistic predictions? Getting the input for G wrong fundamentally compromises the entire calculation of the cost of equity, which means the FM is using a shaky discount rate in their NPV appraisal.
So let's summarize the perfect structure. If a Section C question requires you to write a report or a memo discussing financial management objectives, how should the listener frame their answer using all the conceptual knowledge we've covered?
You should frame the answer in three interconnected layers of analysis.
Okay, layer 1, the decision and its cost.
Right. Start by framing the decision around the need for long-term finance. Is it debt, equity, or a mix? Discuss the implications of that choice on the risk profile, so the gearing and the cost of capital. You should highlight the tax shield advantage of debt and the higher risk premium required by equity holders due to that risk-return trade-off and the systematic risk they bear.
Then layer 2, the market reality constraint.
Exactly. Introduce the external constraints. Explicitly discuss the impact of market efficiency. Since the market is only, at best, semi-strong efficient, the share price used to estimate the cost of equity or the valuation of an acquisition target may not be perfectly fair. And therefore, the financial manager must exercise subjective judgment on things like the timing of new issues and the robustness of their NPV discount rate.
And finally, layer 3, modern pressure and balance.
Acknowledge modern conceptual pressures like fintech addressing security risks, the need for updated regulation against money laundering, and the increasing competition it introduces. And then conclude by linking all these factors back to the overarching goal. Show the constant trade-offs the FM is making, balancing the cheapness of short-term finance against its high risk, or balancing the cost of capital against the inherent systematic risk of the investment project. That synthesis is what delivers high marks. The entire FM role, therefore, is not merely calculating an NPV or a ratio. It is navigating a complex, imperfect market full of systematic and unsystematic risks and constant trade-offs, all with the singular purpose of maximizing the long-term well-being and value of the organization.
And that leads us to a final provocative thought for you to carry forward as you conclude this deep dive. We focus a lot on the long-term objective of profitability maximizing returns through strategic investment decisions. But the FM's job also critically involves liquidity, the short-term stability, ensuring the company has enough cash, which is measured by ratios like the quick ratio and current ratio, to meet its immediate obligations. These two concepts, profitability and liquidity, they rarely coexist perfectly. A company expanding too fast might run into a scenario called overtrading, where huge profitability leads to severe liquidity problems because inventory and debtors are growing faster than the available capital.
A classic problem.
So, considering that acute dilemma where profitability and liquidity are fiercely competing, if you were managing a rapidly expanding company with potentially high profits but critically low cash reserves, how would you define the trade-off priority to ensure long-term survival?
That's a fantastic point to end on. If liquidity becomes a genuine constraint, if there's a real threat of insolvency, the FM must temporarily prioritize cash and stability. As the old adage goes, a company can be profitable and still go bankrupt if it runs out of cash.
So survival trumps everything.
In the short term, yes. The management of short-term working capital through tools like cash budgets becomes the immediate objective, even if it means sacrificing some high-return long-term investments until the cash flow position stabilizes.
A masterful summary of the complex reality facing every single financial manager. If you are preparing for your ACCA exams, this conceptual grounding is what converts knowledge into marks. Don't let this knowledge sit idle. Make sure you take action on this deep dive. Subscribe to the SmartPass YouTube channel for full ACCA exam-focused deep dives and comprehensive explanations. And for daily exam tips, revision strategies, and updates, follow the SmartPass Instagram page, which is linked below this video. Go make the most of your studies. We'll catch you on the next deep dive.